Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Welcome back to the show, Tim.
Jim, as always, thanks for having me.
Gold seems to have hit its top, but everything seems to be topping out. Can you maybe explain?
Well, yeah, gold, I had said that, I thought that the bounce out of the bounce, it was more than a bounce, man. It was a really good move out of the December low. But I said that in the context of, the higher degree 9-year cycle, that I thought that it was a counter trend advance. And I think we talked about it, and it was certainly in the letter. I can't remember from one interview to the next what we talked about, but it was certainly in the letter that the July high was setting up to be an intermediate degree top, and that has proven correct, and that gold should move lower. And that's exactly what has happened. Gold stocks were just creamed this last month. They're up nice today. But I think that's, another counter trend bounce. Crude oil, same thing. We talked about the seasonality and how you tend to get the tops in the summer and the bottoms in the in the winter. And we had the intermediate and higher degree seasonal cycle, I call it, top in crude oil back in June. And then we had the counter trend bounce, which is, out of the early August low, which has failed. And we're seeing the weakness there. So, all that is on track. Our thoughts with the dollar, with the 4-year cycle top, and we've had the last, several days, we've had, week or so, we've had some strength in the dollar, but again, I think that's been counter trend. And that the dollar continues down with its 4-year cycle top that's in place. And then we have the equities to hold out. I have looked at that and looked at equities and looked at equities from every angle. And, people may think that, well, he's just going to be bearish no matter what. And actually, that's not true. I have tried to find a different angle, and it is what it is. Some have said that we had a 4-year cycle top, even back then, and some more recently have said that we had a 4-year cycle top in 2011, and that was a 4-year low in 2011. You and I weren't doing those interviews, but it's in print in my letters. And I said back then, no, we're going higher because we didn't have our DNA markers in place. And, all throughout this extended cycle, they had tried to set up, but then they never would materialize. And it wasn't until 2014 it really started trying. In 2015 it did, June of 2015. Well, believe it or not, even though the industrials have managed to squeak out a new high, the Dow theory events, trend change, bearish trend change that occurred back in June, July, and into August of 2015 are still intact. And because of that, that's kind of the umbrella. I mean, that is a warning that things aren't right. The great Dow theorists in the day, they said, when the averages are disagree, they're screaming, be careful. And that's exactly what they're doing. And the general public thinks it's a breakout. So, no, I think everything is setting up for a top. It isn't one. I mean, it is we've seen, the most outlandish, coordinated, however you want to say this, intervention program in the history of man. And that's not an excuse. It's a fact. I mean, it is. And it's created the most extended, 4-year cycle advance since the inception of the stock market averages. And that's a fact. And, there's no question what that Dow theory is telling us. It's not an excuse. It just is. And, while everybody's sitting here looking at this as a breakout, I think it's more of a fake out. And, the topping process just continues.
Now, of course, we've paid attention to the people I call yell and sellers on business television networks. Why are they still so hot on several stocks or some stocks? And you're saying this is the best time for you to take your cash and run.
Well, the technical guys, and it's not just me, but technical analysis, and I think that the powers that be use and understand technical analysis and have used it very well as it to help keep the markets afloat, buying at the right time, coming out with the right news at the right time, and having the Bank of Japan or whoever make an announcement at just the right time. So technical analysis is very much alive and well, but at the same time, the guys like me that use technical analysis to the folks that don't understand technical analysis have been, I'll admit it, it's been terribly discrediting, and the people the yelling and what'd you say, the buy, how did you describe them?
I called them the yell and sellers.
Yeah, the yell and sellers on, they've appeared right. But, I guess the answer to the question is, I don't know what anybody else is saying. All I know is what the Dow theory and the technicals are telling us. And, it's been like watching paint dry, watching the technicals fall in place. And, those guys, they did not warn, of a top in 2000. They did not warn of a top in 2007. They did not see the commodity bubble. They're always bullish about everything all the time. And it's always about buy the dip. They don't see the bigger picture. And I guess, in all honesty, I guess there's an aspect of that statement that you could mirror it, back at someone like myself who's been saying what I've been saying is this bubble has continued to stretch and extend and morph, but that is in fact what's happened. And it is in fact a house of cards. And the chickens will come home to roost, and we're at another one of those junctures.
We'll have more with Tim Cyclesman Wood right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, let's go through some of the individual sectors here and take a look at what's happening. Gold, for example.
Gold is, like I said, gold is right on track. It's moving down now. We should be at or near a short-term low. There's going to be, another bounce, but I think overall we've seen the advance out of the December low. And, any advance from here is counter trend, and we're going to move lower with some higher degree cycle lows and down into the 9-year cycle low. And then I think it's going to be one heck of an opportunity, for the gold bugs. And I don't, single them out. I mean, for everyone, for myself, I mean, I see everything washing out into a low together. And then I think gold is going to be, I think it's going to be an awesome opportunity once we get to that 9-year cycle low.
Do we know when that's going to happen?
Late this year, early 17 is the timing. What we need to see as we move into that timing, we need to see specifically the structure fall in place. And, that's a day-by-day thing that you look for with, the shorter degree cycle lows and then the intermediate degree cycle. I mean, it's price action tells us that as we get closer.
Oil.
Oil, same thing. I think we're retesting. Like I said, we've seen the intermediate degree top, and we are going, I think ultimately lower into, winter.
Of course,
December, January, that time frame. We're moving lower.
Of course, we usually see lower oil prices over the winter. Will it be worse this time than last year?
Not sure if oil, it's kind of the test. We're gonna retest. It's very possible, actually, that we do violate the February low. I'm not sure. The forecast based on statistics, as crazy as that sounded at the time, was that we moved into the 20s, and we did with that low. I think we're gonna at least retest that low, stress it, but I don't know if we will violate it or not. I don't know that at this point.
Natural gas, of course, I think depends on what kind of winter we expect to have. So far, I'm hearing forecasts that it could be a cold one.
Yeah, and I don't follow natural gas that closely, so I really can't speak on it.
Mm-hmm. And other commodities, I've heard that car sales, except for Fiat Chrysler, down. Have they kind of run the range there in the automotive sector where 0% loans stretched out over 8 or 9 years? Has that sales boost run its course?
Jim, I actually track and follow the, I don't follow it every day, but I download it in my database and keep an eye on it, the Dow Jones Auto Manufacturers Index, and it's definitely weaker than the market itself. It peaked back in 2015, and the structure there is definitely, when I say structure, I'm talking about the technical structure of the market or that index is definitely weaker than the overall market. So it tells me, looking at the chart, that there is trouble, or weakness, if you will, in the auto sector, which tells me there's problems with the economy. And, so yes, I see weakness ahead in automotive for sure.
Well, just taking a look at August sales, Ford and GM sales were expected to drop a bit, but they fell more than they expected. Fiat Chrysler did sell more vehicles, but not as many as they thought they would. And of course, now, maybe it's tit for tat. Germany says Fiat Chrysler has had some kind of deal where they could control emissions testing. And of course, Germany was stung when the U.S. accused them of having Volkswagens with switches that could fudge their emissions tests. And Volkswagen is the biggest company in Germany and probably the best-selling vehicle in the world right now. I think they surpassed Toyota. So maybe Germany is just wreaking a little revenge here.
I don't know. I don't know what's going on that front. Looking at the charts, though, I think there's weakness ahead in the auto sector.
Now, that's bad news for Canadian and U.S. manufacturing because the auto sectors between the two nations are so closely tied together, right?
Sure. And looking at even parts, the automotive parts sector looks it looks weak. I mean, my God, it peaked in June of 15, and it's down. I don't know what percent that is, but considerably from there. Of course, it has been in a counter trend bounce along with everything else back in from the January, February lows this year, but it's rolling now as well. So I think that's probably a sign for things.
What are all these subprime auto loans going to do to the financial sector?
Well, I've heard people talking about that, and I that may well be the same sort of thing this time for the auto sector that we saw with housing before. Absolutely, I have heard the talk about that. That could very well be the case.
Tim, how would you sum up the equity markets right now?
Well, Jim, to the people that don't understand, I understand. Looking at, listening to someone who has talked about the dangers of the market for so long, after a while it becomes, ho-hum, the guy that cries wolf. But, nothing has changed and I don't mean to sound like I'm apologetic for that. I am and I'm not. I'm going to stick to the work no matter what the work says. And, like I said, we're dealing with the most insane financial experiment in known to man. And again, it's not an excuse. It's a fact. I mean, just why would one think that they have done the things they've done if things were so great? And so that's an obvious, undeniable fact that we've seen those extreme measures. It's also an undeniable fact that yes, as a result of that, it has extended this cycle beyond belief. But it also is a fact that it's a mirage. It hasn't changed anything. I mean, think about the insanity of this. On the one hand, you do more of the same thing that created the worst financial crisis since the Great Depression, and create an even bigger bubble. What do you expecting a different outcome this time? And that's not going to happen. So yes, we have this extended move, but we also have the technicals and the Dow theory that are warning and have been, and it is what it is. And I don't know. We cross through these technical junctures, if you will, and what I mean is it's opportunity. It's like, I may have said this before, it's like going to an intersection, and when you go to that technical intersection, it's an opportunity for the market to turn. Doesn't mean it has to, but the opportunity is there. And we're going through another one of those technical junctures now. One of them, I don't know if it's this one. I don't know if it's another 6 months down the road, or if they can kick the can down the road, as they say, another year or 2 or 3. Like I said, this is uncharted water, but it is one hell of a bubble, and it will, at one of these junctures, it's gonna be the real deal. And when it does crack, I don't think there's anything anybody can do. And I'll stick to this too. This sounds crazy, and I admit it. I almost don't even believe it. I'm not sure I do believe it at this point. But the statistics tell me that based on, over 100 years of market history, that the current risk to the market is that when this extended 4-year cycle does crack, that it takes us below the 09 low. That sounds crazy, but that's what the statistic says. And I have to stick to that statistic. That is the risk. That is the underlying risk associated with this Dow theory setup that we have and that we have had. Now, I don't know if that statistic is going to be fulfilled this time or not. If it's not, then it's the first time since the inception of the averages that it won't be fulfilled based on, the setup. But until we see that it is not fulfilled, I have to assume that it will. And so I guess the context in which I say that is that is a measure. And I know that people don't understand really what I'm talking about, but that is a measure. That is the degree of the risk. And I think that degree of risk is known, and I think that's why we have seen the extreme measures that we have seen. It's all been in an effort to prevent that statistic from being fulfilled, because that risk is that great.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views, which you can find online at cyclesman.com. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward your questions to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.